This strategy simplifies investment decision-making, reduces risk through diversification, and aims to provide a balanced approach to achieving both income and growth. In this video, I'll discuss 4 types of investment funds that I believe everyone should consider having as part of their investment portfolio. One of the fund types I'll talk about is rarely discussed as part of a diversified portfolio, but I believe it is an overlooked gem that most people should include, so be sure to check out that part of the video. Having the 4 types of funds I detail in this video will provide broad market exposure, steady income through dividends, capital appreciation from growth sectors, and diversification benefits. The first type of fund I believe that everyone should have is a foundational ETF, which is the cornerstone for diversification. The foundation of a diversified investment portfolio begins with a base ETF that tracks a wide area of the market. I have 2 favorite base funds, both make solid foundational investments. I do want to point out that a lot of the funds I talk about in this video are Vanguard funds. This is for 2 reasons. First, Vanguard is a reputable company with high quality ETFs, and second, it is known for its low investor fees. The first foundational fund that I love is the Vanguard Total Stock Market ETF, or VTI. This fund offers expansive coverage of the U.S. equity market, including small, mid, and large cap growth and value stocks. With over 4,000 holdings, VTI's massive diversification reduces risk, while its low expense ratio of 0.03% ensures more of your money is invested in the market, not in management fees. Its track record of an 11% average annual return over the past decade underscores its reliability as a foundational investment. Another very solid foundational fund is any fund that tracks the S&P 500. For me, I love VOO or VOO, which is the Vanguard S&P 500 ETF. This fund tracks the 500 largest companies in the U.S. and represents the performance of major industry leaders. The S&P 500 is largely regarded as the best single gauge of large cap U.S. equities. Like VTI, VOO boasts a low expense ratio of 0.03%, combining efficiency with performance, having also averaged over an 11.5% return annually over the last 10 years. These solid funds act as the foundation of a well-balanced stock portfolio, creating a strong base to build upon with other types of investments. To complement your foundational fund, you now need a dividend-paying ETF for stability and income. Dividend ETFs often provide regular income alongside capital appreciation. Dividend-focused ETFs are a key component. My favorite dividend ETFs are the Vanguard High Dividend Yield ETF, or VYM. This fund targets companies that pay above average dividends, making it an attractive option for income-seeking investors. This ETF's emphasis on sectors like consumer goods, healthcare, and financials, which offer traditionally higher dividends, provides a balance between yield and risk. With an expense ratio of 0.06% and a history of solid performance, VYM stands out for its combination of income and moderate growth. Another strong and very popular dividend ETF is the Schwab US Dividend Equity ETF, or SCHD. This fund is designed for investors looking for high dividend yields with a preference for stability and quality. SCHD selects stocks based on criteria like consistent dividend payouts and financial health, leading to a portfolio that has historically offered robust yields and reliability. Its relatively higher dividend yield compares to VYM, and a focus on quality make SCHD an excellent choice for dividend investors. Now that we've set up our foundation and our stability and income part of the portfolio, now let's explore a way to supercharge the growth of our portfolio. I just want to take a quick second to ask a quick favor of you all. Most people who watch my videos are not subscribed, so if you don't mind, please hit the like and subscribe button. All right, back to the video. We'll do this by adding a growth ETF. For investors aiming for higher returns through capital appreciation, growth ETFs capture the potential of dynamic sectors like technology. My favorite option is the Invesco QQQ Trust. This fund focuses on the NASDAQ 100 index, which includes technology giants and innovative companies in sectors like biotechnology and renewables. Its orientation towards high growth areas offer the potential for significant returns, albeit with higher volatility. QQQ's performance with an impressive average annual growth rate over the past decade underscores its appeal for growth-oriented investors. The second growth ETF I love is the Vanguard Growth ETF, or VUG. This fund offers a broader take on growth investing, including over 250 stocks across various sectors. With a lower expense ratio than QQQ and a diversified growth approach, VUG is an attractive option for those seeking growth with a slightly more conservative stance. The last type of fund that I think perfectly rounds out a well-diversified portfolio is a fund that focuses on real estate. Many videos talking about 3 fund portfolios or other ways to diversify often overlook real estate, and I think this is a mistake. Real estate ETFs or REITs offer diversification and income. Real estate investments add a layer of diversification to a portfolio, often moving independently of traditional stocks and bonds, and can provide both income through dividends and potential capital appreciation. The first real estate fund I love is the Vanguard Real Estate ETF, or VNQ. This fund gives investors exposure to a wide range of real estate sectors, including REITs, focusing on commercial real estate, residential properties, and healthcare facilities. VNQ's blend of growth and income, along with its diversification benefits, makes it a solid choice for real estate exposure in a four-fund portfolio. The second real estate fund that I love is the iShares Cohen & Steers REIT ETF, or ICF. This fund provides an alternative option for real estate investment, focusing on large, dominant REITs. ICF targets the largest U.S. REITs, which tend to own high-quality, well-located properties. This focus on premium real estate assets can offer both stability in terms of income and potential for appreciation growth. This makes it an excellent complement to the other components of a diversified portfolio. Together, these ETFs form a robust four-fund portfolio that covers the essential aspects of investing: broad market exposure with VTI or VU, income and stability with VYM or SCHD, growth potential with QQQ or VUG, and diversification through real estate with VNQ or ICF. This strategy simplifies investment decision-making, reduces risk through diversification, and aims to provide a balanced approach to achieving both income and growth. Whether you're a seasoned investor or just starting, this four-fund portfolio offers a structured path to building a comprehensive and diversified investment portfolio. Thank you so much for watching. If you haven't subscribed already, please consider doing so. If you're not sure what to watch next, check out this video right here. YouTube is recommending. I think you will really enjoy it. Take care, and I will see you next time.